So there's just not a lot of buying pressure, new buyers and stuff to follow through and keep chasing price higher. And so that's kind of why and that's, I guess, to me, that's a real world application of that COT report, which you can't really use to trade, but you can use if you understand where price was and can correlate that with COT positioning, and then you can kind of begin to anticipate what might happen next. And so that's kind of why gold is kind of stuck where it is, even though it is 2,550 bucks.
Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics. And fortunately, we have one of our favorite guests on the show returning today because I am joined by Craig Hemke of the TF Metals Report. And we're going to dig into a lot of things that have happened throughout this year, and also be great to get your insight, Craig, on now we're already in September, what you see happening in the remainder of the year. Certainly, in some ways, already an historic year, and who knows what the markets hold next, except for Craig. So that's why we have you here. And Craig, welcome on in. Great to see you as always. How are you today?
I'm fine, my old friend. It's nice to see you as well. Welcome back, my friend, to the show that never ends. Come inside, something like that, right? Isn't that how the song goes?
Yes, yes, and has not ended. Although, like I mentioned, we've had a good year so far. And
Mhm.
Craig, I think you interviewed me for Sprott Money earlier this year, but I don't. I think this is the first time in 2024 that I've gotten to ask you some of the questions on my mind because certainly we started the year hearing about 6 or 7 rate cuts.
Yeah.
Seems like we're finally going to be getting one next week, but even without that, like I mentioned, has been a historic year. And here on Tuesday afternoon, we have 25.45 on the gold futures, silver up at 28.70. And I'll give you two parts here. A, anything in particular that has stood out from what we've seen in the first 8 months, and also any expectations as we start to head towards the end of 2024.
Well, you can just get up and go walk around if you want. I got it from here. That's a nice question I can really run with for a while. Um, going back the first of the year, it had just gotten so crazy by the end of December about how there were going to be 7 rate cuts, and all this jazz. And the bond market had been rallying and the dollar was falling. And if you remember, gold tried to break out on the 1st of December, and then it got a manufactured rug pull on Sunday night, the whatever that was, the third, into Monday, the fourth. And that kind of stalled the breakout for about 90 days. And then but we didn't know that, that the breakout was coming. And the first of the year, it was like, I mean, most everybody knew there weren't going to be 7 rate cuts. I mean, the Fed was telling you, they've been slow walking this stuff for a long time. It wouldn't be more than 2 or 3. So you knew that had to get worked out. As it got worked out, the dollar rallied, I don't know, 5 or 6%. The yield on the 10-year note went up, 50, 60 basis points. And you'd have thought, oh, wow, man, they're going to beat the snot out of the precious metals in the first quarter. And the opposite happens. Um, you know, I know we've talked for the last couple of years. I know I've included in my little annual thing I do in January. And then once you make a new all-time high and break out in anything, you generally add about 10% to price just from, good feelings, some good publicity. People think they're missing out, and so the whole bunch of new money rushes in. And that's why I always thought gold might go to 2,300. Well, and here we are, 25 something, and have maintained and have broken out since, even a little further then we go into this 3.5 month range. Now we've broken out of that. So it is really almost kind of counterintuitive what has taken place. And it leaves old time, old time analysts such as myself, kind of wonder, okay, what do we get wrong? What am I missing here? And I'm not sure I have those answers at this point. But I'm not arguing with 25, $50 gold, 25.50. That feels pretty good.
Although it's weird, especially in the precious metals community, by the sentiment, you would not know it,
Yeah.
especially
Yeah.
here in the West, and perhaps changing a bit, West getting involved as we get the interest rate cuts. Although, Craig, within all the price context, obviously something that has a big impact, which it's great to get your opinion because I know this is right in your field of expertise. We have a short position by the banks both gold and silver. So here, swap dealer net,
Yeah.
this is our net bank short position, which we can
Yeah.
see during the rally has increased quite substantially. Silver, not a record. We saw the banks hit more short in 2016, although slightly different picture on gold, where last week we did see some short covering, which will be part of this long question, but we are basically at a record high short position for the banks.
Yeah.
And then on last week's COT report, which might add, you do a great job of going through every Friday at TF Metals. So here on the gold side, see about 12,000 contracts, that net short position reduced. Similar here on silver, about 2,300 contracts. So I'm curious, obviously, we've seen this before, where as the price goes up, the short position expands. We have seen short covering at a couple points in this rally. Does that mean if they're covering shorts now, that would you say it's safe to say that, again, it's early, but if we see a continuation of that, that could imply a new floor of sorts, or anything you could touch on the that whole situation?
Well, back to the first part of your question about sentiment. Um, One, when gold goes up, we all kind of, for us that have been stacking physical gold forever, I mean, that feels pretty good. But oftentimes it's like on the back of, oh God, look at what a mess everything is. It's rallying because of geopolitical stuff, or it's rallying because the economy is going to the toilet and we know no more QE is coming and all the $2 trillion in new debt, all these things you're like, oh, I know that's why I bought it in the first place, but God dang, I hate, you know what I mean? So that's always kind of double-edged sword. And the other part where sentiment is really controlled is the people that like myself that have always bought the mining shares thinking that it's some kind of leverage to price, you're going to make some extra fiat, you know and the mining shares just stink on ice. And the exploration companies, oh my God, they're just all little money pits. And for example, I won't say who it's with, but I have a had because I just closed it out a couple days ago. I had a separately managed little account of exploration companies.
No.
And that I'm like, I took some money, put it in there back in about the year 2000, mid 2021. I see, because I'm like, I don't know, when do you sell, and I don't know enough about the geology, and I'll let somebody else do it. So anyway, it was in a little bit of money. It's 50 grand. So it's not like this is like some earth shattering loss that I can't recover from. But 1st of October last year, I'm on vacation. I'm in Vegas to see U2 at the Sphere, and I'm sitting by the pool, and I'm looking at that account, and it's $33,000. And at the time, Bitcoin was $30,000, and it actually crossed my mind. I'm down from 50 down to 33, and I'm like, screw it. I should just blow this out and buy one, Bitcoin with it. And I don't. Gold then, hey, and it's great. Gold goes from 1,800 to 2,500. And I finally blew that account out at $25,000. So gold's gone up by 30 some odd percent. And this basket of exploration companies has gone down, which again, it's not the company, not the manager's fault. It's just a really hard industry right now. And so anyway, tying this all back together, there's so many people that are in the precious metals for the right reason, but they want to make some extra fiat with gold mining companies, and so many of them aren't doing anything or down versus where they were a couple of years ago or 10 years ago or 20 years ago, that people just feel depressed. They've gotten gold up, but they haven't gotten the miners to go anywhere. And there's a really interesting correlation between silver and the GDX that people should explore sometime. I wonder, maybe that's a way that sentiment gets controlled. But I digress. So I think that's probably sentiment, is that one, you're happy to see gold go up, but at the expense of, chaos and madness. And then your mining shares aren't going up. And it just seems like it's just depressing. So anyway, then to the COT report. I mean, remember I mentioned the gold breaking out and going 10% higher a few minutes ago. This may seem like an hour ago because I've been talking for so long in this answer. When gold broke out on the 1st of March, it was Friday the 1st of March, Fed Goon Waller had made some comments about future QE, and boom, it goes up $30, $40 intraday, and breaks out on the weekly chart, goes up $100 the next week. And then over the course of 5 weeks after that, it goes up another 250. So it goes from 2,100 to 2,450 in 6 weeks. If you just look, again, without getting into the nitty gritty disaggregated report of swap dealers and hedge funds and the like, just look at the category of commercials and large speculators. The the commercials were net short. Okay, subtract the short position from the long position. 141,000 contracts when that move started. They're now 290,000. And by the time the move was done, that 6 week move of $250 or whatever it was, they went from 140,000 net short to about 220,000. They're now, so it's an increase of 50%. But now, like you showed, they're now 280 or 90. So when you look at the price action today, we broke out from a 3.5 year range and then rallied $300, $350, whatever it is. We just broke out a couple of weeks ago of a 3.5 month range and haven't been able to do anything. And that's kind of a function of this commitment, the way the structure is a commitment of traders right now. The typical groups, the typical funds, the home office accounts and stuff like that trade gold futures, they're already long. And the short side has been reduced heavily. And so there's just not a lot of buying pressure, new buyers and stuff to follow through and keep chasing price higher. And so that's kind of why and that's, I guess, to me, that's a real world application of that COT report, which you can't really use to trade, but you can use if you understand where price was and can correlate that with COT positioning, and then you can kind of begin to anticipate what might happen next. And so that's kind of why gold is kind of stuck where it is, even though it is $2,550.
Yeah, and would you say it's reasonable to say that when you have a bank short position as large as it is in both metals, but that we would be fair if I phrased it, an increased probability of a larger than normal move in either direction, but basically you have an unresolved factor out there. Is that a fair way to characterize it?
Reasonable probability of exaggerated moves to the downside. How's that? Would that be another way of putting that?
Yeah. Well, with I guess the counter to that, and I'm not suggesting that we're at this point yet, but the possibility that the banks get overrun and have to cover shorts at
Yeah.
a higher price, which we saw last week. I don't think we're to the point where, hey, watch out, there's an
Yeah.
issue here, but
Right. And that is how it works. You know, I get people on X come at me and say, well, if gold's manipulated by the banks, how come it's gone from 400 to 2,400? I'm like, you're not looking at it like a friggin' banker, right? Bankers just want to make this, they want to capture the spread. They want to incrementally make money every quarter, right? That's how they roll. That's why the old notion, rest his soul, but the notion from Ted Butler that one of these times JP Morgan was going to stand down and make all this money. They haven't accumulated 160 million ounces in their vault because they want to make one huge hit. That's not how bankers, if you've ever met bankers, man, that's not how they do business. They want to make money month after month, quarter after quarter, consistently grow it. So gold goes up, and that's fine with the bankers. 10% a year is what gold's done since the year 2000 on average. Okay. That's they can work with that. What they can handle is 50% in a year. I mean, we're pushing the extremes here right now at 25. Okay, that's they're getting underwater in some positions, getting wrong-footed here and there. But when it just incrementally go, or think of them as a retreating army, right? We have this land, and now so we fall back, we build new barricades here, then we fall back and do it again. That's the way to think of the price management, that it moves up in stages. And again, we blew out in March into April. I mean, in a sense, it kind of got overrun a little bit with hedge funds that were short, that were covering, got buy stops as price moved up, and they got a whole bunch of momentum of people coming in. But then it's not surprising that then, we run into this new range where every time it goes to 2,500, straight back down, it goes up, then big red candles again, up, big red candles again. So as long as the COMEX remains the primary pricing scheme for the precious metals, then all bull markets are going to kind of reveal themselves in this same process of kind of two steps forward, one step back, where the speculative money comes in, the banks take the short side, you run out of momentum, price begins to tip over, technical indicators start to tip over, the speculative money rushes back out, the banks cover up half of those shorts that they put on. Hopefully, you just put in a new higher low. The uptrend continues. Something else happens. Here comes the name, same rush of money again. Open interest expands. The funds get long, and the banks get short, and then they run out of momentum again. And and you just get this higher highs and higher lows. That's how it works in gold and silver, and that's kind of how we're trading this year too.
Yep. Well, with that said, my next question. I actually ask you this. I'm gonna say every other time you're on the show. I don't not every time yet, but what was it? I think everything you said makes sense, and we've certainly seen that pattern. What was it that happened differently in 2011, especially on the silver side? And since we're doing two-part questions today, what
It's
is
fine.
there a scenario in which whatever happened that led us to a different outcome in 2011 that could occur again, and what conditions would those be, if so?
Um, it's fun. I know you're a part of my site. I do those happy hours every
I
couple of
missed the
months.
last beer with Turd. I'll tell you what.
Uh,
I'm going to make sure I'm at the next one. I'm writing a note
um,
down, and you can hold me to that.
for everybody, if you're listening on my site, we started doing this back in COVID days. We'd have Zoom calls like everybody else, and we'd all have a beer. And on the Zoom call, people can type in and ask me questions, and I'm well, whatever. If you really want to know what I think about something, okay, I'll be happy to tell you. So anyway, in this most recent call, I went down this, that recounting all of that from 2011 as I remember it. I can't seem to remember short term. I'm like turning into my grandfather, Chris. I remember my grandfather could sit there and tell you specific conversations that happened in the Burlington Northern Roundhouse in 1934, right? But he couldn't remember, who came to see him earlier that day. So that's where I'm going. Okay. I can't remember everything that's on my calendar, even though I get the warnings. But I remember what the hell happened in 2011. So as I'm recounting this for everybody on that call, I was like, I should probably, in case I just drop dead one day, I don't just take this to the grave because I don't know. I mean, I probably, and maybe I'm skewed and maybe my story's wrong, but I don't know. I think I know this probably. There's not a whole lot of people
I
left that
love
like,
how we're capturing the general level of optimism about anything in gold and silver here. So now that you've got us warmed up, please continue.
okay. So your role in all this, my friend.
Oh, geez, what did I do?
Yes. Well, but you did. You played an important role in all of this in that you got a hold of Bart Chilton right before he dropped dead. What year was that? When did he die?
That
It's a
was
long time ago now.
2019.
Okay. And I don't, it would be unfair for me to characterize it as a deathbed confession, but he was remarkably frank, or maybe it was just that you actually asked him the questions that nobody ever asked him before. But he
I
shared with you and confirmed a lot of details that we always kind of wondered about, right?
yeah.
Remember the did JP Morgan inherit Bear Stearns' short position and that kind of stuff, right?
Mhm.
And maybe it was just that nobody ever thought to ask him because he was certainly
I think that was the case. And interestingly, if you look at the original, we reposted it later, but if you look at the original one, there was a comment from I believe Sherry Chilton. I think that was his wife's name, but forgetting her if that's not the exact first name, but someone using his wife's first names made extensive comments saying the idea that this was a deathbed confession was false and she found it offensive. So do
yeah.
I know for sure that was her? I can't say that, but at least for context. But anyway, go
But
ahead.
he was very frank and forthright. I mean, you didn't sense like he was trying to obfuscate and dance around. And I mean, you just
He
asked him.
said he said directly he felt that the stuff should be known. So it seemed like he
Right.
appreciated that someone was asking about it.
Okay. So, and it could stop me if I'm like, no, you need to like, no, Craig, that's not exactly how it went. But whatever that was, 2008, Bear Stearns goes TU, and the CFTC goes to JP Morgan and says, we've got this, what is 20, 25,000 contract short position in silver. And you can have it. We want you to take it, but you've got to close it out. And JP Morgan said they would. Am I doing okay so far? Is that how you remember Bart describing it?
Yeah.
And then JP Morgan, being the bankers that they are, got in there and went, hey, wait a second, we can make some money off of this. And so they don't do it. They don't close it out. And they just keep, and probably even made it larger. You start chasing, and you put even more shorts on to the point where it wasn't an existential crisis, but they were losing money. And that last, as silver starts to run, you go back, if you can pull it, and because I remember this at the time, I can't pull them up, say, here's the link. But in April of 2011, that when we went from 38 to 48, that last, that's 20 some odd percent in a month. That was not the shoe shine boy and the taxi cab driver buying silver. That was your short squeeze. That was what was happening then. Was the commercial position was getting smaller and smaller. They were being forced to cover. They were forced to cover because they didn't have any silver that they could deliver. And so as price is going, again, you can see it in that chart. Back here, and I'm pointing at it like anybody can see what I'm pointing at.
Where's Craig's finger going?
So it was 18 to begin the year and then went to 48. Okay. That was the old commercial short squeeze because JP Morgan had assumed that position. They didn't have any silver behind it and they got squeezed. And that's when you had the May Day massacre and the 5 margin hikes in 9 days. And we all know what happened next. What most people don't know what happened next then is about the same time as this was all coming down, rapid rubber stamp approval for JP Morgan to open their own COMEX vault. Yep. That happened in May or June of that year. They went from 0 ounces, anybody can pull it up now, and they haven't added to it now in 3 or 4 years, between 2012 and about 2018, steady 3,000 contracts in this delivery month, 2,000 contracts at house. I'm saying the house account of JP Morgan, their proprietary account, just kept taking delivery of what, I don't know, warehouse receipts or physical silver, whatever. But they went from nothing to 100 and whatever it is today, 165 million ounces, adding up the 2 categories. The only real contact I ever tried to have with the CFTC, I called them one day and said, what's going on here? And I had to leave
tried that once or twice. Didn't go too well for me.
Yeah. I had to leave a voicemail. Some guy actually called me back and said, look, there is bona fide, rest assured, this is all bona fide hedging because somebody had taken delivery of way more than what the front month position limit is off of Dodd-Frank. I'm like, what are you doing? How can you, this is all bona fide hedging, which then got me thinking, okay, if you're JP Morgan and you almost just got, you'd lost a lot of money. They were losing a lot of money in April of 2011. So they said, okay, you know what we're going to do? We're going to take some time. We're going to build up our own stockpile of physical so that this can't happen again. Call it 150 million ounces. That's at 5,000 ounce a contract. That's 30,000 contracts that they can roll from May to July to September to December to March to May to July to September, all these different front months. 30,000 that they can have as a position, and they can look at the CFTC and say, well, look, we have 150 million ounces. We're just hedging. Okay. And so anyway, getting to answer your question now, Chris, when it ever gets sideways again, because of physical demand, the Samsung battery, 500 million ounces a year or whatever, I don't know, whatever. JP Morgan can sit here and continue to do this, layer on the shorts, take them off, layer on the shorts, take them off. But if they ever get called to the carpet again, they can just deliver the metal. And they no longer have this risk, price going to $70 and $80, and they're just short 30,000 contracts, 150 million ounces. And every dollar is 150 million bucks, and it goes up $40 as 6 billion. Whatever that, I lost track of too many zeros, but you get the idea. So that's how I understand what happened back then, and that's how I don't think it'll happen again. That could happen again to a different bank, maybe. Um, but anyway, that's the current state of the market. God, what are we even talking about? I talked for so long that now people are already tuned out. So
I
for those
asked you
people that
about
still
the Jets game on Monday, and somehow we
yeah,
turned around and got to this, which is
what?
better than thinking about
All
the
right.
Jets on Monday. But while I have it up, I'll just mention here is again that bank short
Okay.
position. So interesting. Here's now again, this isn't just J.P. Morgan, but here's the collective total, and you can see we're we're in a different league right now. So
Yeah.
um,
You can see where if you look really close and if you can draw straight lines, you can see where rallies often begin from where the swap dealer net is near the blue line or the purple line. When they're somewhere near flat, that's when rallies begin. And when they are well below that line, like right in the middle there, below the word dealer or above the word short, you can see how, what year is that, Chris? I got to put my glasses on so I can see myself. Like right there in 2016, we had that great run up in 2016. See the big, huge increase. Yeah. And then what happens? Price falls in the back half of 2016 and all those shorts get covered and kind of roll. So anyway, that's kind of the problem now. Silver took off. Now silver's not quite the same as gold from a positioning standpoint. Silver took off back on March 31st. It was actually Easter Sunday night when it finally really got rolling. And if you go back and look at how the funds and the banks were positioned back at very first week of April, last week of March, it's not dissimilar from where they are today. It's pretty close. Banks might be a little heavier short, but the funds are about the same net. So there's room for hedge fund and speculator buying to come push silver back up toward the top, where it was back in May. But it's got its own little headwind. You probably may have seen me or heard me mention before. I kind of think of silver. I'm looking around for something to pick up. Think of silver as like the hinge of a teeter totter,
yeah.
And on this side you got gold, and the other side you got copper. And if you can elevate the whole teeter totter, get gold and copper going up, then silver's gonna go up at the same time. But if gold goes up and copper goes down, silver kind of just sits there in between. And that's what happened since May. I mean, gold's higher than it was in May, but copper's down 20% from where it was in the middle of May, and then silver's down 10. So we need part of this getting silver. Why is silver lagging gold and all that kind of stuff? We need that kind of commodity reflation, global economy, physical fundamental play to kick in again, and it just hasn't for the last couple months.
All right. So what I'm taking away here is it's time to use the headline. Craig Hemke says silver going to 200 within the next week as the COMEX collapses. That's how I'm translating that. So,
Yeah, no, please put that up there because there are so many people that love those headlines like that, and then they'll say this guy's been saying silver to 200 for 15 years and he's never right about anything. And so anyway, please use that as a headline. Craig Hemke
well,
said,
at least on the positive side, I mean, in defense of gold and silver and people who talk about it, I mean, I don't know if you go back even 5 years. I mean, gold was 1,200, close to 1,000, and
yeah,
it's doubled since then. So at least it's certainly nice to see that some of the things we're not saying what should happen theoretically. At least we're seeing some evidence of that manifesting. So
yes. And again, you've heard me say it a million times. I mean, it's the end of the debt-based, the Keynesian system, right? And it's a mathematical certainty. You get to the point where you just simply cannot service existing debt. You can't grow your way out of it anymore. And the law of compounding interest just eats you alive. And that's what makes gold. I mean, it just doesn't make it, it's not complicated. Um, the hard part, like I said, is the silver market's so small and it's almost like non-existent to investors. It's the old um, Grant Williams thing about nobody cares. I mean, you care, I care. Most everybody listens, cares. We all own silver, but it's just not on people's radar. It's just not. I mean, there are some companies that need it, for their technology, so I guess it's kind of on theirs. But even for, you talk about its use in solar panels or whatever. But I can't tell you for sure how many ounces of silver are in a solar panel. But if, $1 higher per ounce at the margin maybe doesn't make that much of a difference to the solar panel maker. I don't know. It just doesn't seem like the supply, demand, the market structure, how prices is covered, all that kind of stuff. It just doesn't seem like there's enough people that really interested in it to move the needle.
Yeah, and I think, when we look at what gold's done and how silver feeling like it's underperformed that, I think a big part of that, especially the central bank gold demand, there's been a lot more money going into gold. We
Yeah.
have not, I can't point to a tangible data point that says there's been a new rush of retail investing into silver or a central bank doing that. Um, if actually you look at Silver Institute and World Gold Council numbers, they have $128 billion of investment into gold last year. You want to guess how much into silver?
28 cents. What?
S- 6 billion.
Yeah.
So 128 to 6, if you ever see any of that change.
Right.
Although the fact that I know we're flipping this around when we wrap up here, and I'm going to be on the call with you for Sprott Money News, and we'll talk a bit more about that. The fact that half of the world is decided they don't want to use this system anymore, which is not
Yeah.
to say that, that changes overnight, but I think that's a little bit of a problem on some level. So either case, a lot happening, but I appreciate everything you shared here to put some context on some of these dynamics. And I might add for anyone who is not already aware that Craig, you do a fantastic job. I've been a subscriber to your site. I don't know how many years,
As
but
long as
it's
there's been one.
been a long time. And
Yeah.
perhaps you could just let people know where they can find you and sign up for the newsletter and get some of your daily updates.
Well, if you like long range conversations and bloviating, obviously, I'm the guy to do it for you. But I'm only semi joking. You're looking at the site. This is what I do every day. There's a post in the morning. There's a podcast with the count. See the count yesterday? That was fun because Mario Draghi, the count, came out yesterday and said the EU needs to spend 800 billion euros a year in kind of monetary stimulus to promote their 800 billion a year. So that's a lot of euros and further debases. So we're not just talking dollar-based, dollar price gold or people that own dollars worrying about the devaluation of their dollars. It's euros and pounds and yen and everything in between too, right? So post and a podcast every day. The main thing is, and again, I don't mean this from a self-effacing standpoint. The community is what makes the site. It's all the other members that you see how there's 104 comments on the weekend one and the 57 comments on another. People are all day long adding links and videos and kind of scouring the internet for relevant information that day or any day. And so anyway, I charge $15 a month just because you got to keep the lights on. And God, you can't believe how expensive health insurance is these days. But again, in a time like this, which is just crazy, I think any shelter in a storm, your site and all that you do, provides great information as well. Any place where you can kind of surround yourself with people that are actually paying attention and can help you navigate, the waters is money well spent. So anyway, that's a long-winded, rather strange commercial for what I do, but that's what I do. And we try to, again, what value, my value is if I can save you a little bit of money buying physical, by following the price, give you kind of a heads up when it's like right now, the last 5 Septembers have averaged a 3% loss for gold. Now that's a pretty small sample size. And the seasonals for gold have typically always been pretty good, September and October. But the last 5 have been lousy. So, maybe if you were thinking about buying gold back, last week, maybe you wait, give it a couple weeks and see if the price doesn't come in a little more. That's the kind of analysis we try to do to
Well, you
and
do a
from
great job of that. And also, something that I really appreciate is you have the morning column and then another column that includes the podcast in the afternoon. But one of the things I really enjoy the most is that you cover a lot of, you're a great aggregator of the things that are happening there. So, if someone, especially if there's a day where someone's busy and want to get a quick idea of what's been going on and some of the insane things that are coming out. So, I think there's a lot of great things you do. And I'm proud to be a subscriber at the TF Metals Report. And again, you can find that at tfmetalsreport.com. Makes sense. I like the website link and the business lines up there. So anyway, Craig, sure appreciate this. I know people always like to hear from you, and I'll make sure we don't have this much time go on in between next time. But thanks again for joining me here, and we will talk to you again soon, my friend.
it's always great to see you, Chris. Keep up the good work.